Is private equity bad for franchising? Is it bad that there's these very large investment funds that are coming up and buying whole franchise brands? If you're curious, stay tuned to today's video as we're going to review if private equity is a bad thing for the franchising industry. I would argue that private equity is a net positive for the franchising industry as it brings in capital to this business model that, depending on the product, the service being offered by the franchisor to the franchisee to the end consumer, can be a really good model for everyone in that value chain. It also professionalizes many brands. So imagine a founder that was really good as a fitness instructor or a chef and has built up 10 locations with a couple of franchisees, more corporate locations, and has hit a roof where that influx of capital can be really helpful, and the knowledge of the private equity fund and the relationships they have to bring in experienced managers to bring that franchise brand to the next step can be really helpful. Keep in mind, you have two types of private equity. You have growth oriented. Those are the ones I like. They generally want existing franchisees to open up more units, grow the system from 100 to 1,000 units. They're going to invest millions of dollars in marketing, brand development, operations, the management team, growing together with franchisees. The end goal might be to IPO, sell the stock on the New York Stock Exchange or the NASDAQ, or maybe sell to a larger private equity group. There's potential to roll up other franchise concepts. You see that a lot in the home service business. I've identified at least 5 home service franchise platforms that are private equity backed, usually by competing private equity firms, and they're buying up smaller franchise brands. So there's the opportunity to grow something bigger, and there might be synergies between those brands if executed correctly, or the synergies might not be there, but that could be a whole nother episode. And the key with growth private equity in the franchising space, if the number one focus is on the unit level economics, how much the franchisee gets, EBITDA, how much the owner is making, benefiting from the business, what the sales are like. And then they're also supporting the franchisee to continue to improve the unit level economics and really hear them out. It should work. But it comes down, is the number one focus unit level economics? And if it is, and expanding through having really solid financials at the franchisee level, usually it's going to work out. So maybe a franchisee with previous owner averages 2 locations and made $150K operating those 2 locations. And then now with the new private equity owner, the systems in place, the experienced franchise coaches helping franchisees are now able to have 5 locations and make $600K with a regional manager. And the owner operator is not just bouncing around those 2 locations, but has a more professional team. And he's able to learn a ton from the new owner's new management team that have come into his franchise brand that he is a franchisee of. So it can work out when it's growth capital and the franchise is owned by a company that really wants franchisees to make as much money as possible and not profit on the franchisees in all different types of ways, but primarily focus on royalty fees collected. Now, you have the second type of private equity investor that's more about internal improvements, or you could say extracting as much profit as possible. So making improvements, focusing on the profitability. So the problem with this type of private equity investor is there's some low-hanging fruits dangling for them in the franchise agreement that they can take advantage of. So most franchise agreements, let's use an example of an education franchise that might have been bought last year, 200 franchisees, and they were not using their own materials, their own education materials. They decided to have an affiliate company use education materials and collect massive rebates from that affiliated company and dictate that their franchisees have to buy the materials from that affiliated company, even though they're super expensive and the workbooks are not as good, the education materials aren't as good. Franchise agreement says they're able to take rebates and control the vendors. You as a franchisee have little say, and that franchisor might have just had a profit of $1 million, $2 million plus incremental by being able to sell you at a nice markup the products and services that you're offering to the final franchisee. Even some of the processes that you need to use that are supposed to make your life easier as a franchisee. The franchisor with the new ownership can just decide, we don't like that old POS system. We're going to bring in this POS system that we're going to get more rebates from, or that our affiliate company owns a POS system. Let's also bring in that marketing agency that we're going to create another company owned by the franchise brand that also owns this marketing agency that's going to do all the marketing for the franchisees. And it's not going to be so transparent where those ad funds are going, where those marketing funds are going. So you can see how most franchise agreements are written. The franchisee is really trusting in the franchisor to do the right thing. And maybe with that founder owner or that growth equity type private equity investor, they're going to do the same thing. They're really going to focus on the unit level economics of the franchisee. But if you have a group that's coming to make a quick buck and come in and exit in 2 years, 3 years, maybe acquire some other franchise brands along the way to roll up and then sell, it can be a nightmare for franchisees. And that's where we've seen at Vetted Biz lawsuits tend to happen a lot with franchise associations against a franchisor, where the new owner comes in play and the franchisor is trying to make as much money as possible. And the sad thing is, this is only a small minority of new owners are doing this. But we've seen at Vetted Biz, these private equity groups or family offices have done this multiple times for different brands. So they've gone in as a cancer to these different brands and extracted as much money as possible from the franchisee without helping the franchisee be more profitable. And it just leaves basically an organization that's defunct, and they try to sell that as fast as possible. So at Vetted Biz, we have been working with some of those growth equity type private equity investors. We do not work, I have no interest to work with the internal improvement private equity groups, and really prefer to support the growth equity investors, as I think it's a net positive, that type of private equity coming into the franchise space and bringing the franchise brands up to a different level where they can expand nationwide and make more money for the franchisees. So there you have it. Private equity is a blessing for the franchising industry and essentially improves overall the economics of franchisees, of the franchisor, and oftentimes delivers a better product or service to the end customer. However, there's a big distinction between a growth equity investor and one that's more focused on internal improvements, aka let's extract as much money as possible from these franchisees and then sell the business to someone else. Shoot me an email at patrick@vettedbiz.com if you have any experience, positive or negative, with change in ownership, whether you're a franchise executive or a franchisee. I'd love to hear from you.